An executive found out his company got hacked. He sold his stock within the hour. One employee got fired for it, but 147 million people were affected. The company kept making the same mistake. As recently as this month, you almost certainly have a file with this company. You never signed up for it. This is why. You've never signed up for this company, but it doesn't matter. It already has a file on you, built without ever asking. Your social security number, your address history, your credit accounts. In 2017, hackers stole that exact file for 147.9 million Americans, roughly half the adult population of the United States. One Equifax executive knew the company had been hacked before the public ever found out. His name was Jun Ying, Chief Information Officer of Equifax's U.S. Information Solutions Division. He sold nearly $1 million of his own Equifax stock within the hour. Somebody has to answer for a breach like that. Logically, it should be him. But it wasn't Jun Ying. Equifax is one of 3 companies, alongside Experian and TransUnion, that decides what your credit looks like to a bank, a landlord, an employer. You don't choose to have a file with them. Banks and lenders report your activity to them automatically, and Equifax builds a profile from it, sold to whoever needs to check whether you're worth lending to. You can't opt out. Here's the part that explains almost everything else in this story. You are not Equifax's customer. You never pay Equifax directly for anything, not a subscription, not a fee, nothing. The banks and lenders who buy access to your file are the actual customer. You're the product being sold, which means Equifax has very little financial reason to treat protecting your data as its top priority. Its actual paying customers were never the ones at risk in the first place. In March 2017, the Department of Homeland Security warned Equifax about a specific software flaw. Company policy required a patch within 48 hours, but nobody applied it. A follow-up security scan 6 days later, designed specifically to catch exactly this kind of miss, failed too. Equifax employed 225 people in cybersecurity. Not one of them caught it. Hackers walked in through that same unpatched hole on May 13th and had access for 2.5 months before anyone noticed. Here's the detail that makes it worse. Equifax finally spotted the intrusion because of suspicious traffic on its own consumer dispute website, the exact tool built to let people challenge mistakes on their credit report. The system meant to fix errors is what accidentally caught the company's own security failure months after the fact. There was a second fear regulators had that got far less attention. Hackers didn't just have the ability to steal Equifax's data, they had months of unsupervised access to alter it. New York's state financial regulator was concerned enough that it ordered every bank and lender it oversees to independently verify Equifax credit data before trusting it, because nobody could be fully certain what the hackers had touched while they were inside. When it finally became public, Equifax needed a story. The CEO, Richard Smith, gave Congress one. A single employee, he said, had failed to forward one email about the patch. That employee was Graham Payne, a senior vice president who had managed almost 400 people over 7 years, consistently highly rated. He was fired. Smith kept his job for weeks after. The public went looking for someone to blame too, and largely got it wrong. Equifax's chief security officer, Susan Malden, quietly retired the same week the breach became public, and people online discovered her degree was in music composition, not computer science. It became a viral punchline. The internet convinced it had found the smoking gun, using roughly the same level of scrutiny Equifax itself had applied to that missed patch. What most of that pile-on missed was that she'd spent 14 years actually working in security before Equifax, longer than most of the people mocking her had been in the industry at all. The real failure was structural, a missed patch and a failed scan, not a resume. Here's what the CEO didn't lead with. On August 25, 2017, close to a month after Equifax's own security team first found the intrusion internally, and 13 days before the public was told anything, Jun Ying texted a colleague, "Sounds bad, we may be the one breached." Nobody had told him directly. He pieced it together from clues, like canceled executive travel, and his own team suddenly pulled in on a weekend. Instead of raising the alarm, he researched how a competitor's stock had reacted to its own past breach, then exercised his stock options and sold. all within about an hour. He avoided roughly $117,000 in losses. He pleaded guilty to insider trading in 2019. His sentence, 4 months in federal prison, a $55,000 fine, and restitution of $117,117. He wasn't the only Equifax employee to take that route either. A separate software manager used the same window to trade stock options and made roughly $75,000, later sentenced to 8 months of home confinement. Trading wasn't limited to those two either. Days after Equifax's own security team found the breach, 3 senior executives, the chief financial officer among them, sold a combined $1.8 million of their own Equifax stock weeks before the public was told anything. An internal investigation cleared them of wrongdoing. Whether that clears the optics is a different question. Weeks before any of this became public, Smith stood at a business school breakfast in front of students and faculty, praising the company's momentum. "The days are bright for Equifax," he told the room. He already knew by then that hackers had been inside the company for months. When Congress finally got him under oath, he spent more than 2.5 hours testifying, opening with an apology and closing by defending the company's decision to wait 6 weeks before telling the public anything. His defense was that one person didn't do their job. When asked why the public wasn't told sooner, he pointed partly at Hurricane Irma, which he said had knocked out 2 of the company's call centers. The chief security officer and the chief information officer, David Webb, both quietly retired 8 days after the breach became public. Nobody involved in the actual decision-making lost more than a job. In 2019, Equifax agreed to pay up to $700 million, the largest data breach settlement in history at the time. $425 million of it was set aside for the 147.9 million people whose data was stolen, and the deal initially let each affected person claim up to $125 in cash. So many people filed a claim that the fund couldn't actually cover it at that rate, and the payout per person dropped instead. Equifax also committed $1 billion to fixing the security it hadn't bothered to fix in the first place. Even Equifax's apology tour went wrong. The website it built for people to check whether they'd been affected sat on an unofficial-looking web address, so easy to mistake for a scam that Equifax's own social media team accidentally linked to a fake copycat version of it more than once before anyone caught it. A company that couldn't recognize its own website was now the one deciding whether your identity had been stolen. The free credit monitoring it offered originally came with fine print, quietly waiving people's right to sue the company, a clause criticized so heavily that Equifax had to publicly reverse it within days. You'd think that would be the end of it, given everything that already happened in 2017. In 2022, a coding error caused Equifax to wrongly lower the credit scores of tens of thousands of people in New York alone. Some of them denied loans or charged higher rates because of a mistake the company made. Not them. It settled for $725,000 in January 2025. That same month, regulators ordered Equifax to fix its complaint handling process and fined the company another $15 million for still failing to properly investigate consumer disputes, the exact kind of basic accuracy failure you'd assume they'd have fixed after 2017. This month, July 2026, a court gave preliminary approval to yet another settlement, this time covering roughly 37,000 people whose collection accounts Equifax reported more than once on their credit files, sometimes making them look like they owed money twice for the same debt. Anyone affected has until September to file a claim. The mistakes never actually stopped. They just got smaller and quieter, and easier to miss if you weren't already paying attention. You never signed a contract with Equifax. You never agreed to their terms of service. You don't get a say in whether they hold your data, only in how badly they're allowed to lose it before anything happens to them. For some of the people affected, that meant years of monitoring bank statements for a fraudulent account they never opened, or explaining to a lender why their identity had shown up somewhere it shouldn't have. Remember, you were never the customer here. The banks checking your file were. For nearly a decade, the actual customer never had a reason to demand better. So nothing about the underlying incentive has changed, only the size of the fines. One employee lost his job for missing an email. The man who sold his stock within the hour served time in federal prison for it years later. after the story had already moved on to other things. The company that lost the data of half the country is still making the same kind of mistake, this year, this month. Only one part of that sentence should feel surprising to you. The rest of it is just Tuesday. This is the markup.